Thanks for joining us today. You know that we have some competition just down the hall, and it's really great to see some old friends here and meet some new faces as well. I want to tee up my comments in terms of why money is so important for economic opportunity in general, and then quickly jump to some policy considerations in terms of reforming the Fed as we sit here today, and give you something to chew on that we could circle back maybe in the Q&A. You know, you ask yourself, I remember when I was getting my PhD and, I was telling my dad I was going to study money, and he just thought I was nuts. It's like, wow, you know what, I give people green pieces of paper and they do stuff for me. I asked him, why? I mean, why in the world would you do something for a little stupid green piece of paper? In other countries, they don't do things for us with green pieces of paper. And there's a famous paper, Nairana Kocher-Lakota is the current president of the Minneapolis Federal Reserve Board, and he coined this term that money is memory. In small societies, you don't need money. There's a house burning, let's suppose our community is about the size of this room. Your house is burning, everybody shows up, and they help out. And if you don't show up, it's a real stigma, right? That is favors in this, when you're interacting a lot face-to-face with people, you can trade goods and services without much in terms of frictions. Now, if you want to scale an economy, you need something that acts as a claim check. And that something can be things like stone wheels in Micronesia. It could be cigarettes in a prisoner of war camp. Indeed, cigarettes did trade as in several prisoner of war camps as money. But if money is really a claim check, notice that it has to hold its store of value. And one of the things that we learned from these prisoner of war camp experiments was that, the prisoners are kind of clever. They're just like, a monetary policy authority. They like to print money. And so when the Red Cross would drop off cigarettes, they'd unroll them and they'd make 2 cigarettes out of 1. You'd have $2 rather than just 1 cigarette. Right? And what would you see as the rations were being traded for cigarettes? The price would go up. That is, the money didn't hold its store of value. In not holding its store of value, you'd see consequences for the real economy. Likewise, when rations weren't delivered frequently, when there's a slowdown in the delivery of the rations, there was a slowdown in the prisoner of war economy. There weren't enough monetary services. There weren't enough of those claim checks that were circulating. So the store of value is really important here in terms of letting money, whether it's an exchange economy like a prisoner of war camp, or a production economy where you need to innovate. I've got an idea, you've got the resources, we can get together and both be better off. It's important that that claim check holds up to its promise. And as we sit here today, there are some proposals that would affect the integrity of that promise. Importantly, it concerns how the presidents of the Federal Reserve banks are nominated and confirmed. If you think about a constituency in the United States that is, has a vested interest in price stability, it's got to include people who are making fixed rate mortgages, right? You don't like inflation if you're making fixed rate loans. Who's making fixed rate loans? Commercial bankers. How do the district bank presidents, the 12 district bank presidents, who nominates those 12 people? It's the board of directors at each of the districts. Where do those directors come from? They're elected by the bankers that are in that district. They're supported by the people who have a vested interest in price stability. We have a proposal now in the Shelby draft bill and there's a lot of talk on both sides of the aisle in terms of having the New York bank president become a presidential nominee, and there are also calls to have all the bank presidents be presidential nominees. When you look at the data support this hypothesis that the district bankers are stronger supporters of price stability than are the presidential nominees. That is, the 12 they vote more consistently for price stability than do the 7 presidential nominees that are confirmed by the Senate. Now, there's a term coined in economics that we'd rather have rules than discretion. Rules rather than discretion, and that's right as far as it goes. And indeed, another part of the proposal that are running around as we sit here today is to report on the rule. Here's the rule that we used. Here's why we may have, gone outside the rule. All that's great. Rules are better than discretion. I would argue that incentives are even better than rules, right? It matters how you get to the table. It matters how you get to the FOMC roundtable in terms of how you're going to implement those rules. If your incentives are stronger for price stability, as the data and the theory suggests the president's are, well, you want to keep that institution in place. And I'll end by just noting that there are actually bipartisan proposals along this line. The former President Fisher of the Dallas Federal Reserve Bank has been advocating for some time to have more of those presidents sitting around the FOMC table and having a formal vote in the monetary policy during each meeting. That is sort of putting more weight on the voice of the presidents. Representative Brady, also from Texas, has another proposal, again, moving in the same direction, where he wants all 12 of the district banks voting in each meeting. So one of the things I think a lot about is the incentives. What are the incentives that the nomination and the confirmation process bring to the table? And and think about the policy proposals that we're hearing around this town in that light, how we're going to change the nomination and the confirmation of the 12 presidents or even the Board of Governors. So I'll leave it at that in terms of teeing up some questions. I'll look forward to your comments.
Okay, so I usually try to be objective, nonpartisan, academic at these things, but I'm just coming off of 2 years as chief economist at House Financial Services, kind of being in the thick of it. It's going to be tough to be objective. I'll just disclose that conflict. It's sort of like trying to be objective about, one of my kids. I just think they're awesome. But let me just describe a little bit about some of the items that were developed at Financial Services over the last couple of years, and then talk about a little bit about the proposal percolating on the Senate side from Chairman Shelby. So the approach that the House Financial Services Committee took last year, after a series of almost a dozen hearings into the Federal Reserve's history and operations, had three central themes. Legislation introduced by Chairman Garrett and Congressman Huizenga, now Chairman Huizenga, did three central things, I would say. It did a lot. It's about a 50-page bill, but the three central themes there were themes that I had expected, I think we had all expected, would have some bipartisan traction. I have to say they haven't gained bipartisan traction yet in the House, but they do all come from ideas from both sort of sides of the aisle historically. The bill does three things. First, it requires the Federal Reserve to adopt a rule of its own choosing. And a rule is just an equation, just a mathematical equation to describe the course of monetary policy. And the thinking behind that approach is that picking words out of a thesaurus to describe monetary policy, which is effectively what FOMC statements do now, can never be an effective substitute for math in communicating the future course of monetary policy. That's an idea that Chair Yellen was very supportive of during the mid-'90s when she was a governor on the Federal Reserve Board. It's an approach she no longer supports now that she's Fed chairman. But that's the general sort of idea. The second general theme of that legislation was a requirement for the Fed to conduct cost-benefit analysis when it adopts regulation, a requirement by statute. They say they do it now, so the idea was just to codify what they already do. Cost-benefit analysis is an idea that has found support, on both sides of the aisle. The Clinton administration was very big on cost-benefit analysis and regulation. In the Obama administration, a law professor who had taught with President Obama at the University of Chicago, named Cass Sunstein, left his mark on the cost-benefit analysis procedures of the Obama administration. The way I would describe it is this: I think under Republican presidents, conservative economists, regulation is sort of playing an away game. I think under liberal presidents and liberal economists, regulation has a home field advantage. But I think there are still rules of the game that both sides respect. So I generally think it's been a bipartisan idea It hasn't been bipartisan politically in the House yet, but I hold out hope that it might still be in the future. And then the third central theme of that legislation was transparency in regulatory operations, and that's something that has also, I think, received some bipartisan skepticism. The Fed's process, the New York Fed's process of bank examination, has received a lot of criticism from the left side of the aisle, from the right side of the aisle. I think the stress test process and the living will process have both been fairly opaque, as the Fed and the FDIC, in terms of living wills, have implemented those new tools under Dodd-Frank, and so the legislation sought some additional transparency. I hold out hope for the prospect of bipartisan interest in the bill, but if not, I also would expect that there's a high degree of probability that when the Congress comes to the debt ceiling discussion, Fed reform will be a candidate for attachment to the debt ceiling discussion. It's germane because who buys up most of the debt that got us to the next ceiling? Federal Reserve. Federal Reserve's bought up trillions in debt that's brought us to the next ceiling. So it's part and parcel of the budget and spending discussions that will take place at that time. And I think also it's politically interesting because some of the same members who would prefer never to increase the debt ceiling are the members probably most interested in Fed reform within the Republican caucus. So I think we're likely to hear it again, even if it doesn't obtain bipartisan support. So that's the House side. The Senate side has legislation that does a variety of things. One of them that was inspired by the Huizenga legislation was a requirement that each of the governors receive 4 staffers. They don't have any staff now. It's hard for a member of the Board of Governors to be an independent voice on the board when you have all your staffers provided by the chairman. And so I think that's a very interesting, very important piece of the Huizenga bill that was put into the Shelby bill. The Shelby legislation also has an idea, inspired by an idea developed by the Joint Economic Committee and Chairman Brady of the JEC, to have a commission to study the Fed. It's a little bit more limited than the Brady Commission. The Shelby proposal would restrict that commission to examining the structure of the Federal Reserve System. But I think that's a vitally important question for all the reasons that Dino just described. There's a debate going on about the influence of different parts of the Fed system on the FOMC, the Fed board versus the district banks. Proponents of empowering the district banks over the board on the FOMC urge that it brings more of a voice of Main Street, less of a voice of DC insiders and Wall Street insiders that you see in the Fed board and the New York Fed. And so empowering the other Fed district banks might bring more of a sort of a Main Street voice to the FOMC. I also think another important part of that consideration is just Fed independence. You'll see a theme running through all discussions of the Federal Reserve of the importance of the independence of the central bank, and I would agree entirely that that is of vital importance. We never want to threaten the central bank's independence. I don't think Congress could threaten the central bank's independence if it tried. The fact that the Fed's not on appropriations means that Congress has no tool to effectively challenge the Fed independence. That's my view. But I think the executive branch has a number of tools to threaten the Fed's independence. And if you look at the history of the Fed, from any of the major histories of the Fed, you see running through the narrative over 100 years threats to every Fed chairman from every president of the United States. Usually it runs in the influence of encouraging more accommodative policy, because accommodative policy helps incumbents, presidents win re-election. And the pressure comes from a number of ways. One of them is just closeness to the president. Most Fed board members right now served in the Clinton White House, and a number of them served in the Obama administration. A couple of them have gone back and forth. Fed staffers have gone back and forth to the Treasury Department. So there's that, and the other aspect, I think, which threatens the Fed independence is the fact that Fed governors and the Fed chairman hope for reappointment from the president. And I think human beings, being human beings, there is no way for that not to threaten your independence from the executive branch. And so I think Fed independence is an important piece of this discussion, and a reconsideration of Fed structure to empower Fed district banks can actually help to protect the independence of the Federal Reserve from the executive branch. So I think it's, I haven't seen, I think the Shelby legislation has very high hopes of bipartisan appeal. I haven't seen objections to the items in the Shelby legislation on Fed reform from any of the Democrat senators yet. I haven't read them if they're there. So I think that's a very interesting piece of legislation and has a bipartisan track possibly going forward. So.
Thanks for having me. After the recent crisis, many have blamed Fed actions as causes of the crisis, like loose monetary policy. Or perhaps they point to the problem of the resolution of the crisis, like Fed lending to insolvent institutions. Calls for Fed reform accordingly seek to address those problems. While I don't blame the existence of the Fed itself for the crisis, I believe the Fed, FDIC, and OCC played an important and often overlooked role in engineering the crisis through the seemingly innocuous rule change called the Recourse Rule, which was finalized on November 29th, 2001, effective as of January 1st, 2002, although you could get a jump start if you wanted from the day of the finalized rule. The Recourse Rule did to capital requirements what Basel II, for the most part, was going to do. So even though we never adopted Basel II capital adequacy standards in the U.S., effectively by adopting the Recourse Rule or finalizing the rule, we did. So so how is that causing a problem? The Recourse Rule specified that private label asset-backed securitizations, things like ABS, MBS, CDOs, collateralized debt obligations, all these acronyms that we heard throughout the financial crisis, there was a huge increase in the origination of these securities. So the Recourse Rule, which previously treated standard commercial loans with an 8% capital charge, what that means is banks had to have 8% capital to back an asset holding like that. But under the Recourse Rule, if you now held an A-rated security, you could drop your capital charge to 4%. And if it was AAA or AA rated, you could drop that capital charge to lower to 1.6%. We saw an explosion of AAA rated and AA rated security originations, especially with CDOs, which topped out at something like $1 trillion. I think 700 billion in the structured finance industry itself. And often those securities had liabilities that were 70 or 80% rated as AAA, even though the underlying collateral might have been only triple B rated. I think this rule single-handedly explains why we had a financial crisis, because the rule change stimulated the demand by banks to hold CDOs as well as private label mortgage-backed securities. This in turn spread insolvency risk throughout the financial system, especially the banking system. Insurance companies also had incentives to adopt or use these securities because they could benefit from lower capital charges as well. So even though the Recourse Rule did not affect insurance companies, the insurance industry was following similar principles. Without the Recourse Rule, the demand for CDOs and underlying private label mortgage-backed securities would have been very different, much lower. And large commercial bank and investment bankers would not have been looking so hard to find risky loans to originate to subprime and Alt-A borrowers. So what are my key principles? Well, rather than continue with Basel-type capital adequacy standards, if we're really serious about bank stability, and more importantly, not making taxpayers foot the bill every time there's a crisis for another bailout, then why don't we just simplify capital requirements and raise capital requirements? That could, in terms of simpler capital requirements, that could be just having rules whereby banks must fund, their capital must be comprised of just long-term debt and equity. And there are a number of proposals out there for raising capital requirements. The reason for doing that is simply higher capital means you have a safer bank. Another idea would be maybe you want to remove the rulemaking and supervision role that the Fed plays in the banking system. Maybe we could have a single financial regulator, not 2 or 3 regulators for every part of the financial system, or at least for some parts of the financial system we seem to have overlapping regulators. The taxpayer could use a break. So maybe something like the OSFI, in Canada. So I think I'll conclude my statements with that, and I'll pass it on to Hester first. Thank you.
Thanks, Steph, and thanks to all of you for being here. So Steph lays out that regulation played a role in bringing us the last crisis, and that regulatory decisions were made poorly and therefore had real effects on the real economy. And one of the things that Dodd-Frank did in response to that was to give more power to regulators to make more decisions in the financial system in the hopes that they might make them better next time than they did the last time. And in terms of moving to a single regulator, that was actually under consideration in the lead up to Dodd-Frank and was not adopted technically, although the Fed is trying very desperately to become the single financial system regulator, and it's made some headway in that. Dodd-Frank not only expands the types of institutions that the Fed can oversee, but it also has given the Fed an ability to go deeper into the institutions that it oversees. So it's a holding company regulator, but it's now able to go deep into the subsidiaries of the holding companies. So, for example, the Fed is now a major insurance regulator because so much of the insurance industry is held within holding companies that the Fed oversees. And then, of course, Dodd-Frank created a new class of institutions, systemically important financial institutions, and those institutions are overseen by the Fed. And the Fed has a lot of the Fed discussion of late has been, we really need to have a better access to other parts of the financial system that are now regulated, for example, by the Securities and Exchange Commission, because we worry that things that are going on there could affect financial stability. And so there's actually a fairly intense disagreement between the SEC and the Fed over who ought to be regulating the capital markets. One approach that the Fed is now employing is macro-prudential regulation, and this approach, rather than looking at trying to ensure that individual financial institutions don't run into trouble, they look instead at ways to ensure that the whole financial system is stable. Which means that the Fed sort of views the financial system as a portfolio of companies that it oversees, and so it can make decisions that might hurt one piece of that portfolio in order to benefit the system as a whole. And this is a nice idea in theory, but as Steph just outlined, a mistake made by a regulator exercising that kind of power can have tremendous consequences for the financial system. So the bottom line is we need to pay attention to the role that the Fed is playing as a regulator. I think we need to have a discussion about whether it makes sense for the Fed to have a regulatory role at all. Monetary policy is a big mandate, and so you may not want to also have a regulatory mandate. Maybe allow the Fed to concentrate on monetary policy, which, to be honest, many of the people who go to the Fed really are thinking of it in terms of monetary policy institution, and they get there and they realize, oh, we also have regulatory responsibilities, and it's sort of a side issue for them. And then we should also, JW mentioned the importance of economic analysis. The Fed has lots of economists, and so economic analysis is a natural thing for the Fed to do, but they've been quite hesitant to actually perform economic analysis and show it to the rest of the world so that other people can see what sort of assumptions they're making, what sort of considerations they're taking into account. Another area to think about is that Dodd-Frank required that there be a vice chairman for supervision at the Fed. No one's been named in that role. But because the Fed is playing such an active role and has so much discretion in this area, it's probably an area where additional accountability could be helpful. And then just more broadly, the Fed as a monetary policy institution, as JW mentioned, it's really important that it be independent. as a regulatory institution, it's really important that it be accountable. And so I think the Fed is trying to come to terms with the fact that on the one hand, it's a regulator, on the other hand, it's a monetary policy setter. And the type of oversight that applies in the regulatory world is more intense than the oversight that they're comfortable with on the monetary policy side. So I'm just making a pitch for you all to keep in mind as you think about the Fed and the monetary policy world, which Scott's going to talk about in a second. Remember, too, that they do play this important regulatory and supervisory role on the other hand.
Okay, thank you for inviting me. I'd like to talk about two ideas very briefly today. One of these is having the use of prediction markets at the Federal Reserve to help it forecast the economy and hopefully develop better monetary policy. So prediction markets are markets that are constructed solely for the purpose of trying to derive essentially market predictions. One example you may have heard of is the Iowa electronic markets, which does things like forecast election outcomes and so on. And research by a number of economists, including Robin Hanson and Justin Wolfers, has found that these prediction markets are often very good at sort of leveraging the wisdom of crowds and coming up with fairly efficient forecasts, better than any single person could do. A number of corporations have created prediction markets within the firm to forecast sales and other things of interest to corporations. So the thing that's kind of strange in economics is we often think in terms of market forecasts as being the most efficient, and yet we don't seem to be very interested in constructing markets to get forecasts that would be useful. Now, one piece of evidence that market forecasts are useful is that we know from the minutes of Fed meetings that they discuss things like the tip spread. The tip spread is essentially a bond market forecast of inflation. So the Fed is very interested in what the market thinks inflation will be over the next few years. Obviously, that's one of their mandate. But there's also other equally important, and I would argue even more important macroeconomic variables like nominal GDP and real GDP and so on, where we don't have a market forecast currently, but we could easily create a prediction market to find these. In fact, I can tell you it's relatively easy because I did it myself last year. I raised a little bit of money on my blog and set up or had a group called Hypermind set up a nominal GDP prediction market. And so that's up and running, but obviously the amount of money I had to work with was somewhat limited. The Federal Reserve would be able to do a much better job if it were to set up that sort of market. Now, one question is the Federal Reserve actually authorized to do this? And I'm not an expert in this area. I've talked to people that are a little bit unsure. It's not apparent to me why they wouldn't be authorized to do it. It's an important tool for economic research, and economic research is part of the Fed's job. But, I mean, that would be something where Congress might play a role in terms of deciding whether Congress felt that that was something that the Fed was authorized to do. And again, I'm not an expert in this area, but it's something that I think Congress might want to think about. Either they like the idea or they don't, but make it clear whether that's something that's part of the Fed's mandate. So the other thing I want to talk about briefly is Fed accountability. There's lots of ways of looking at it. I'd like to briefly discuss what I think is the minimum acceptable level of accountability. And this isn't necessarily the ideal level of accountability, but again, the minimum acceptable level. So think in terms of the Fed's dual mandate. They have basically inflation and employment as the two variables they're really told to focus on. Low inflation, high employment. Now, importantly, both of these variables are influenced by the Fed, if at all, by changes in what's called aggregate demand or total spending in the economy. So the Fed sort of sets a monetary policy stance, and by stance I mean they set indicators like interest rate targets, or they do a certain amount of QE. So they have these tools or levers for affecting the economy. That's called the stance of monetary policy. And then over time, this influences the economy. Okay. And basically, what they're trying to influence, again, is those two variables. Now, here's the thing. The Fed, as far as I know, doesn't really have any explicit framework for going back and revisiting whether its decisions were correct or whether the policy stance was set at a level that was, in retrospect, too expansionary, or was it set at a level that was too contractionary or about right? Okay. Seems to me this would be a very useful thing for the Federal Reserve to do. Now, in fairness, they do go back over sort of ancient history and discuss whether they've made mistakes. So the Federal Reserve, including top officials like Ben Bernanke, have explicitly said that the Fed made serious mistakes during the Great Depression and also during the so-called Great Inflation of the 1960s to the early 80s. So they've conceded serious policy errors in those two cases. What I'd like to see is something more recent. So something that's at least once a year where the Federal Reserve would look at their previous actions and say, okay, and I would even let the Fed decide what criteria to use, but actually issue as part of their statements a report that says, in retrospect, we feel that the growth in aggregate demand was about right for achieving our goals, or in retrospect, it was too slow or too expansionary. And that would also, I think, help markets better understand what the Federal Reserve is trying to do. Sometimes it's difficult for markets to sort of figure out what the Fed is trying to accomplish. It would also help Federal Reserve's policy sort of fit better together with fiscal policy. Obviously, it would make no sense to do, say, fiscal stimulus if the Federal Reserve thinks aggregate demand is in the right place. After all, fiscal stimulus is designed to boost aggregate demand, so the Fed would just be offsetting that and so on. So in terms of, minimum level of accountability, certainly you could go beyond this, and I personally favor things like nominal GDP rules as options to look at, but minimum level of accountability would be for the Federal Reserve to sort of set its own criteria, what it's trying to achieve, and then periodically go back over previous decisions and tell us whether, in retrospect, the policy stance was too expansionary, too contractionary, or about right. Thank you.